Welcome back to the Daily Crypto Deep Dive. Today we're stepping away from the usual rapid-fire headlines and slowing this right down, because something genuinely interesting has been happening beneath the surface of the market. Over the last few days, geopolitical uncertainty has clearly increased. Iran is back in focus, Venezuela has re-entered the conversation in a meaningful way, and global political risk has risen. Yet instead of collapsing, Bitcoin has held firm. And in parts of this period, it has actually moved higher. That feels counterintuitive to a lot of people, because for years the default assumption has been simple: war, sanctions, instability. That's risk off, and risk off means crypto gets hit hardest. For a long time, that assumption was broadly correct. So the question we need to answer today isn't whether Bitcoin is bullish or whether this is a breakout. The real question is why Bitcoin has gone up during geopolitical uncertainty this time, by how much it has moved in practical terms, and whether this behavior is normal, or whether something genuinely different is happening now. In price terms, Bitcoin hasn't exploded higher, but it has shown resilience. We're talking about moves of a couple of percent during periods when headlines were worsening, and traditional markets were uneasy. More important than the exact percentage is the behavior. Bitcoin has refused to break down. This hasn't been a euphoric rally. It's been a refusal to panic. Markets often tell you more by what they don't do than by what they do, and the absence of panic here is meaningful. The reason Bitcoin dropped during the Ukraine invasion but hasn't collapsed this time comes down to the condition of the market going into each event. On the day Russia invaded Ukraine in February 2022, Bitcoin fell sharply, by nearly 8% intraday, dropping into the mid-30,000s. As global markets rushed into risk-off mode. That move wasn't simply fear reacting to headlines. It was a structural unwind. At that point, crypto was coming straight out of the 2021 bull market. Leverage was still elevated. Liquidity was thinning as central banks began tightening, and correlations across risk assets were spiking. Funds needed cash, margin requirements increased, and Bitcoin was sold aggressively because it was one of the most liquid assets available. As prices fell, that selling triggered further pressure, reinforcing the drop. This cycle looks very different. In the lead-up to the current geopolitical uncertainty around Iran and Venezuela, markets were already positioned defensively. Leverage had been reduced well in advance, retail speculation was muted, and derivatives funding rates were subdued rather than stretched. That meant there was no large pool of forced sellers waiting to be flushed out. So when geopolitical risk rose this time, Bitcoin didn't face the same mechanical selling pressure. Instead of an 8% drawdown, it held its levels, and even moved a couple of percent higher at points. The key difference is that today's market is absorbing uncertainty from a crouched position rather than from a position of excess. Without heavy leverage to unwind, and without a scramble for cash, price behavior changes completely. And that explains why Bitcoin's reaction now looks so different from what we saw in 2022. But what happened next is where the story becomes more nuanced. In the days and weeks after the invasion, Bitcoin stabilized and then rebounded. That rebound didn't come from optimism about the war. It came from secondary effects: sanctions, capital controls, currency instability, and the realization that crypto rails were being used in real time for donations, cross-border transfers, and financial workarounds. The initial reaction was fear, but the reassessment phase was structural. That two-stage pattern, immediate risk-off followed by reassessment, has appeared more than once in Bitcoin's history. There's also a behavioral element here that's easy to overlook, but it matters a great deal. Markets don't just react to events themselves, they react to how prepared they feel for those events. Going into this latest bout of geopolitical uncertainty, traders were already cautious, already aware of the risks, and already positioned defensively. That means the shock value was lower. When everyone is braced for bad news loses some of its power. In contrast, the Ukraine invasion in 2022 arrived into a market that was still overconfident, over-leveraged, and unprepared for a true geopolitical rupture. Today's market is leaner, more skeptical, and more risk-aware. That difference in psychological positioning changes how price reacts, even when the headlines themselves are serious. Fast forward to today, and the key difference is that the market hasn't been heavily leveraged going into the uncertainty. Positioning has already been cautious, liquidity thinner, and expectations more restrained. Because of that, the classic stampede for the exit hasn't materialized. Instead, Bitcoin is being treated less like a speculative bet that must be dumped at the first sign of trouble, and more like a neutral global asset that can actually benefit from certain types of instability. That doesn't mean Bitcoin is a perfect hedge against war. It isn't. But it does mean its role in the financial system has evolved. This is where Venezuela becomes central to the story. Venezuela isn't just another emerging market headline. It's one of the clearest real-world examples of how crypto is actually used when traditional systems break down or become hostile. For years, Venezuelans have relied on stablecoins and peer-to-peer crypto markets to move value, protect savings, and transact outside broken financial infrastructure. When sanctions tighten, political risk rises, and access to dollars becomes constrained, crypto demand doesn't fall. It often rises. Not because people are speculating, but because they're surviving. To understand why crypto adoption in Venezuela matters so much in moments like this, you have to remember just how extreme the situation became. At the height of the crisis, Venezuela experienced hyperinflation, measured in the hundreds of thousands of % annually, wiping out savings almost entirely. Monthly inflation routinely ran into double digits, sometimes far higher, meaning money lost value not over years, but over weeks and even days. Wages became almost meaningless. Many workers were earning the equivalent of a few dollars a month, even in skilled or public sector roles, while basic food costs ran far beyond that. Access to US dollars was restricted, banking infrastructure was unreliable, and international transfers were heavily constrained by sanctions and capital controls. In that environment, stablecoins became a lifeline, not a speculative tool. People used dollar-pegged stablecoins to preserve purchasing power, receive remittances from family abroad, pay for goods informally, and move value outside the collapsing local system. By the late stages of the crisis, estimates suggested millions of Venezuelans, a meaningful share of the adult population, had interacted with crypto or stablecoins in some form, whether directly through wallets or indirectly through peer-to-peer markets. The key point is that this wasn't niche adoption. It was necessity-driven usage at scale. And once that kind of behavior is embedded, it doesn't disappear. It becomes part of how value moves when traditional systems fail. That matters enormously when geopolitical headlines involve countries like Venezuela or Iran. These aren't isolated conflicts. They're deeply entangled with sanctions, energy markets, capital controls, and currency flows. Bitcoin sits right at the intersection of those forces. When markets see rising geopolitical risk involving sanctioned or semi-sanctioned states, two things happen at once. First, there's the instinctive risk-off impulse. But second, and increasingly important, there's a structural bid that appears underneath the market, driven by the understanding that crypto is one of the few neutral, permissionless rails available when traditional systems are stressed. That bid doesn't always show up instantly, but when leverage is already lower and positioning already cautious, it doesn't take much to tip the balance. That's why Bitcoin can rise during geopolitical stress rather than collapsing. It's not celebrating conflict, it's repricing utility. Iran adds another layer. Any escalation involving Iran immediately raises questions about oil supply, inflation, shipping routes, and global trade. Those questions feed straight into macro expectations. In early 2022, inflation was already surging, and central banks were tightening aggressively, so geopolitical shock layered onto that environment was toxic for all risk assets. Today, the backdrop is different. Inflation is no longer accelerating uncontrollably. Rate hikes are largely behind us, and liquidity conditions, while still tight, are not deteriorating at the same pace. Markets are no longer pricing relentless tightening as the base case. So when geopolitical risk rises now, the secondary effect isn't automatically rates higher for longer. In some cases, it actually increases the odds of central banks being more cautious or flexible. Bitcoin responds to that. This is one of the most misunderstood dynamics in crypto markets. Bitcoin doesn't react directly to war headlines. It reacts to how those headlines change liquidity expectations. If conflict tightens financial conditions, Bitcoin usually suffers. If it stresses trust, access, and neutrality, or constrains tightening, Bitcoin can benefit. That's exactly what we're seeing now. So, is this behavior normal? In one sense, yes. Bitcoin has often shown complex two-stage reactions to geopolitical events. But it is different in how quickly the reassessment phase is arriving, and in some cases, how little of the initial panic phase we're seeing at all. That tells us something about Bitcoin's evolution. It's now held by institutions, funds, corporations, and long-term allocators who don't react to headlines the same way retail traders do. Some may even add exposure when instability highlights Bitcoin's unique properties. The ecosystem itself is also far more mature. In 2022, stablecoins and on-ramps were still developing. Regulatory clarity was minimal, and institutional participation was fragile. Today, stablecoins are deeply embedded in global commerce, especially in sanctioned or unstable environments. Infrastructure is stronger, access is broader, and use cases are clearer. That doesn't remove volatility, but it does change the balance of forces acting on price. None of this means Bitcoin is now a guaranteed safe haven. Gold still behaves differently. Treasuries still behave differently. Bitcoin remains volatile and sensitive to liquidity shocks. What has changed is that Bitcoin now occupies a hybrid role, part risk asset, part hedge against monetary dysfunction, part global settlement rail. Which role dominates depends on context, and right now, amid Iran and Venezuela-linked uncertainty layered onto a less aggressively tightening macro backdrop, the alternative rail and monetary hedge aspects are carrying more weight. That's why Bitcoin hasn't collapsed. That's why it's held firm. And that's why it's nudged higher. Not because everything is bullish, but because everything is uncertain. And Bitcoin thrives in certain kinds of uncertainty. The mistake is assuming all uncertainty is the same. Uncertainty that tightens liquidity is bad for Bitcoin. Uncertainty that stresses trust and access can be supportive. The market is making that distinction more clearly now than ever before. Bitcoin is no longer just a trade, it's part of the system, even when the system is under stress. And that is the real story behind why it's held up during this period of geopolitical uncertainty. That's where we'll leave it. Drop your thoughts in the comments, smash like, follow for the next one. And as always, we will see you at the top.